Hello, friends. Dramatic day for the markets. Very volatile start to the markets, and then in the second half of the day, just a complete collapse. Um, no place to hide, really. And now the market is in complete grip of intermediate and short-term trends, definitely bearish. Long-term trend still, I would say, still sideways, not yet danger of any long-term trend getting disturbed. But for now, I think it markets will need some time to come to a new equilibrium. So markets basically move from one equilibrium to the other, and essentially this leg of bounce that we had could not result into an extended leg up. Rather, it has now started to be the extension of the down move that we have in September, October, mid-November. I'll show you that on the chart very soon. Uh, we could not defend the 200 DMA this time, and we'll do a study in the second half of the video on how the 200 DMA has behaved in the past. For those who don't know, 200 DMA is the 200 days moving average, and it is a widely followed metrics in the market. So the metric of 200 DMA essentially is nothing magical, but because a lot of people are following it, and hence market reacts very severely near it. So either it will severely bounce from it, or if it is going through it, then a lot of algorithms, a lot of rule-based investors will cut their positions, because their rules may be that if something is going below 200 DMA, we want to get out, or the rule may be that if the index is below 200 DMA, I'm getting out of the market sitting in cash. So many such possibilities exist, and that is why uh, while on their own merit, several of these indicators don't have much value, but because they are widely followed, and hence they become magnets of extreme action at those points, and that's what we will study in the second half of the video. Please do read the disclaimer. This is very important for you, and do subscribe to the channel if you haven't. I have noticed that I think almost 40% of people who watch the videos have subscribed, but 60% haven't. I don't know why, but please subscribe to the channel. It gives a great motivation to the team which is helping me build this content, and they would really like it to see the number of subscribers go up. Here is the chart for the day. It looks dramatic in the sense that yesterday was a very small candle, and today, the whole thing just collapsed here. The 200 DMA was also near 23,800, which has given way 1.52% on Nifty. And now we are hurtling towards this June election top, which had given a very good support uh, in the third week of November when we came down here. And we bounced from it. When we bounced nicely, almost 1500 points bounce happened here. And we are hurtling down again. So this point now, again, as I mentioned yesterday, will become the major sort of lookout point whether markets will hold here or not. And if we do sort of break through this, then it is sort of assumed that this down leg is getting continued here. There's a continuity, and this was just an intermediate bounce. So this holding of this support is important. There is, I would say, in my view, reasonable probability that at least some consolidation may happen at this point. But if we do, break through this, then you know where we are going. So let's not talk about that for now. So this is a very nice, I don't know if I should use the word nice because people will object, but it's a chartically very nice distribution of sorts, where market had run up for many years and now it is distributing, and hence there will be consolidation and downside unless there is a miracle and we break 24,800, which doesn't seem like as of now. So 1.5% down on Nifty. Nifty Junior also smashed down. It is in this gap that was created, hurtling down 2.72% on Nifty Junior. So this Nifty Junior stocks, which are also large cap stocks, are hurtling down much faster in this particular fall, and we have now retraced back to the same level where we were in May. So almost 7 months of retracement of of doing nothing basically in the market on Nifty Junior. Mid caps coming back to this SMA 40, but a complete bearish engulf on mid caps. 2.4% gone on mid caps. Small caps also not spared, again back to SMA 40, but 2.0% on 0.1% on small caps. And again, this has retraced itself back to the July numbers. And Bank Nifty also smashed down. It has now gone below again this June election top 1.58%. So the market has basically given up whatever gains it had in the last 6 months on various indices. Some stocks may have done better since then. A lot of stocks may not have done better. So again, depending upon your portfolio, you may be down 5%, 10%, 15%, 20%, 25%, depending upon the mix that you're holding. Now, this kind of a move has happened last in 2022, where October 21 to about March, April 23, 1.5 years we spent just doing nothing. And right now, the market has done about 6 months of this, the same thing. Momentum trends absolutely in favor of the bears, 438 declines, 60 stocks still managed to show some green. One should study these 60 stocks in case you are doing short-term trading, because these 60 stocks are bucking the market trend. Some of these probably are near some major supports or are, just waiting to go much higher. So this is a relative strength sort of study that you could do. On the Nifty 50 heat map, there is no escaping. ITC probably was one stock along with ICICI Bank, Nestle, Titan, Maruti, which escaped the mayhem. But Reliance, TCS, Infosys, State Bank of India, HDFC Bank, Axis Bank, uh, even pharma stocks today, Cipla, Sun Pharma, Bharti Airtel, Tata Steel, Ultrasemco, Tata Motors, Trent, BEL, everything that you saw in large cap space was getting hammered in a very big way. In the Nifty Next 50, it was deeper red. Everything you are seeing on the screen was just smashed. Look at Siemens down 10%, ABB down 5.8%, and these stocks have done really well in the past. So, very swift damage happening here. DLF Lodha down 5%, DLF 4%. So a lot of positions have been cut today. There's a lot of bloodletting that has happened. LTIM down 6%, Vedanta down 3%. Even Zomato, which is making an entry into Sensex, down 2.2%. Adani stocks all down 3 to 4%. PFC, REC, IRFC, HAL, BHEL, all PSU type of stocks also cracking hard. So this is like a complete market reset that has happened in the last few sessions, where market is now looking for a new equilibrium point to stay, and that has not yet come. Maybe it will come in the next 300, 400 points. Maybe it will come deeper. So no point much talking about sectoral trends. Everything is red. Pharma and FMCG falling the least. Real estate and PSU banks finally collapsing. Till yesterday, real estate was holding very well, still up 9%, 9.7% for the month, but just giving away. So whenever markets uh, come down in such a fall, then it really does not matter. Whoever has whatever position in leverage is the first one to cut, and all other things are set aside, and whatever is a demand supply situation. There is no demand, there are no buyers, there is supply, and it just collapses on itself. You don't need much selling also, it just collapses on itself in terms of its own weight, because there is a complete absence of buyers when this auction happens on the downside. Real estate coming off from this channel high, 3.9%. You can see all these real estate stocks that have been running in the last few days smashed very hard. Lodha, Brigade, Phoenix, Godrej, Sobha, TLF, etc. And in terms of the stock spotlight, General Insurance Corporation up 13.2%. So this is, you have to sit up and see this miracle that is happening. Just like I mentioned earlier, look at stocks that are showing relative strength, that are doing well even in such markets. and that probably may point you towards the future winners, at least in the short term from here. So let's now come to the study of 200 DMA. So Nifty could not defend the 200 DMA today. This is where we are. This is the 200 DMA. The last time Nifty broke below its 200 DMA was very recent in November, just 2-3 days below the 200 DMA, and it sprung back up. And there was a bounce, and now we have again decisively closed below the 200 DMA. So let's see some history about 200 DMA. As I said, that it's a very psychological point. It really has no uh, significance as such. I mean, 200 DMA or 220 DMA or 180 DMA is just a mathematical calculation. But because everybody is focused towards this metric, that makes it important. Just like 50 DMA, 20 DMA, 40 DMA, and so on and so forth. So 200 DMA has a lot of significance. So if we see the last 2 decades, uh, you would find that markets would not go much below the 200 DMA except maybe in extreme situations. So extreme situation happened in 2004 where the BJP lost the elections and there was a crash that happened. The recovery came in less than 9 months below the 200 DMA. Then there was another one in 2006 when there was a emerging market crisis here. That also was recovered in a month or two. Then in the 2008 crisis, uh, you had the market go down. This has gotten cut, but 2008 down move was about a year below the 200 DMA. And then you also had 2011-12 period where the markets just went very, very dull. So there was, almost a year that was spent below the 200 DMA here, and then some sporadic periods in 2013 before the market took off. And then once again in 2016 end, I think this was demonetization and US elections. So some time spent under the 200 DMA there. And then 2018, once the mid cap reshuffle happened from the mutual funds, that was the period where it came off. And then once again towards 2019. So every time in the past, whenever 200 DMA has been breached, it has remained below it from a few days to about a year. That has been the history. And in fact, in the last 4 or 5 years, it has not really stayed below the 200 DMA. So 2021, there was no touch of 200 DMA. 22-23, there were some minor, going down below 200 DMA, but extreme quickly springing back up. And there was no time spent below the 200 DMA. So 200 DMA in the last at least half a decade has done very, very well. If we see the historical, move away from the 200 DMA, so in 2008, we went 45% below the 200 DMA, and that was a huge global crisis. So that is an aberration, along with, I would say, the COVID crisis, which was again a huge global crisis of 34% from the 200 DMA. Besides that, most of the time you will find that 200 DMA has been breached by maximum 10% or so. Even single digit, but 10, 11, 12% somewhere here. And dot-com bust again was more of a global thing where we went down about 26%. So don't really need to fear the market as much. I think market has consolidated 6 months, which is a very good news. I mean, we are not dropping from the peak right now. So whatever, some distribution had to happen, whatever weak hands have to get out, some of it has already happened. And now we are arriving at the 200 DMA, which historically, especially for those who do bottom fishing, for them, below 200 DMA is a opportunity that has come after a long time. And for those who will play momentum, will have to wait till more momentum is there above the 200 DMA. So major moments where Nifty closed below 200 DMA, post all-time highs and hit another all-time high after that is something that we want to study. So 6 months, 1 year, and 2 year performance before and after closing below 200 DMA. So let's do this analytical study. So whenever we've hit a 200 DMA, the previous uh, years have been really good. So 2 year returns and 1 year return. This is of course annualized. So 2-year returns and 1-year returns have been great before we hit the 200 DMA, and this time also 2-year returns is at 28% and 19%. And when we see post 200 DMA, once the price has closed below 200 DMA, we find that the next 6 months, 1-year and 2-year returns on average is also not so bad. So 8% returns in 6 months, 8% in 1 year, and 20% returns in 2 years time period from each episode where a 200 DMA was breached. The only exceptions here, the big exceptions were 2008, where it took more than 2 years for it to come back. But after a GFC kind of crisis, for after 2 years, if you were even, I think that was an amazing outcome. 2018 was one exception here, where there was another crisis within 2 years, and hence, this data was not really applicable. So on average, I mean, you had some great years before the market dipped into a 200 DMA, and on average, post dipping, you would see some decent returns. Of course, not explosive returns in the next 1 year. Although there have been cases where you had a 25% gain here in 2020, you had a 25% gain in 2016, you had a 46% gain in 2006. So really can't say that never again. But the fact is that for long-term investors, and especially those who are doing bottom fishing, this probably is a great opportunity to gradually now add to the market. And even those who are following momentum strategies, where we may be either be going to cash or rotating to more defensive stocks in our portfolios, allocating to the strategy is very important, so that your cash is ready, so that you are allocating to defensives, and you can turn around very quickly. Because once the move up starts, whenever it does, at that point, if you miss the first, let's say, 2 weeks in deciding whether I should put more money or not, then you get anchoring bias, and you start to see the prices at which the market had bottomed, and then you say, I've missed the rally, I don't want to enter now. So always, if you're doing a rule based investing, don't worry about the prices, let the strategy take care of itself. Over the last decade and 2 decades, it has always taken care of itself. The last 8 years of live performance has shown that it has always taken care of itself. So there is no need to worry on that front. The market goes up and down because people want to time the market, in the sense that a lot of folks think that they will be able to go to cash, and then when the market starts to go up, they will be able to buy. Usually people sell at the bottoms, and usually people buy at the tops, and that is the history. So don't try to do these sort of Superman type of activities. Please follow the strategies, follow a rule based system, and you will find that all these movements will just, when you will think about this today's move after a year, you will not even remember it. Let's put it this way: how many of you remember the damage that was done on June 4th? Just 6 months back, we had a huge crisis of 6, 7, 8% fall in index, 15% fall in several stocks, all washed out. Again, the same thing will happen, because you will get on to newer and newer winners, and the old losers will get forgotten. So 200 DMAs, just to give a summary, have traditionally offered massive support. We can expect either consolidation or bounce from here. And even if there isn't a immediate bounce, and even if there is a prolonged period that we spend below 200 DMA, the recovery in the next 1 to 2 years is always reasonably steady. So it is not like market is going, just like market doesn't go to the moon, or trees don't grow to the sky, the markets don't go to zero also. So a lot of new investors probably are watching the market, getting very worried. I would say, if you are not leveraged, if you have not taken any silly positions, if you are fairly you know allocated as per your risk profile, there is no need to worry, because this is an episode that we have seen zillions of times, and at least I have seen in last 30 years zillions of times, and it just passes. Just don't worry about it. So what is your thoughts about it? Do mention in the comment section, and I'll be happy to interact with you there. Do like and share this video with your friends and family who may be worried today. Do subscribe to the channel, and thank you so much for watching. Thanks. Bye.